Ever wonder how Warren Buffett became one of the richest people on the planet? He once said his secret is reading, but he's not just reading novels. He reads 500 pages a day, and most of that is financial statements. Why? Because a financial statement is like a medical record for a business. It shows you everything. Is the company healthy and strong? Is it bleeding cash? Or is it barely hanging on? If you want to invest like the best, you have to learn how to read the X-rays. So, where do you start? There are 3 main documents you need to understand, and you can't just look at one. You need all 3 to get the full picture. Think of it like a 3-legged stool. Without all 3 legs, it falls over. First up is the income statement, sometimes called the P&L, which stands for profit and loss. This report tells you how a company performed over a specific period, like a quarter or a whole year. It starts with the total sales, which is called revenue, or the top line. Then, it subtracts all the costs of doing business, things like salaries, marketing, and raw materials. What's left at the very end is the famous bottom line, also known as net income. The income statement answers one simple, crucial question. Is this company actually profitable? Next, we have the balance sheet. Unlike the income statement, which covers a period of time, the balance sheet is a snapshot at a single moment. Imagine taking a photo of the company's finances on one specific day. It lists everything the company owns, which are its assets. It also lists everything it owes, which are its liabilities. The difference between what it owns and what it owes is the shareholder's equity. The core idea is a simple equation. Assets always equal liabilities plus equity. The balance sheet tells us something vital. Is the company solvent? Can it pay its bills? Does it have enough of a cushion to survive a tough time like a recession? Now for the third, and arguably the most important document, the cash flow statement. This is where you find the real truth. You see, accounting rules can be a bit flexible. Companies can use things like depreciation to make their profits on the income statement look better than they really are. But the cash flow statement cuts through all the noise. It doesn't care about accounting theories. It only tracks real cash. It shows you exactly how much money actually came into the company, as bank account, and how much went out. Profit can sometimes be an opinion, but cash is a hard fact. Here's a huge red flag to watch out for. A company that reports big profits on its income statement but has negative cash flow from its operations. This can be a sign that something is seriously wrong. It might mean the business model is broken, or in the worst case scenario, it could even point to accounting fraud. Remember, a company can't pay its employees or its rent with accounting profits. It needs real cash. So, to recap, the income statement tells you if a company is profitable, the balance sheet tells you if it's financially stable, and the cash flow statement tells you where the actual money is going. By learning to read and connect these 3 reports, you're not just looking at numbers on a page. You're uncovering the story of a business, its strengths, its weaknesses, and its true potential. This is the skill that separates amateur speculators from serious, long-term investors. It's the foundation of how people like Buffett build incredible wealth. Thanks for watching. If you found this helpful, hit that like button and subscribe for more tips on how to invest smarter. See you in the next video.